March 14, 2024, 8:47 a.m. Federal Building, Southern District of New York. The junior analyst in the tax records division doesn't remember what made her pull that single file. Standard Monday morning, coffee still steaming on her desk. She was running a routine cross-reference on commercial properties in Midtown Manhattan when the address flagged, not through any automated system, but because her eye caught a discrepancy. The assessed value, $47 million. The annual tax statement filed, $12 million. The owner of record, Meridian Properties Group, a company she'd never heard of. She made a note, flagged it for her supervisor. By 11:23 a.m., that note had escalated to the IRS Criminal Investigation Division. Within 48 hours, federal agents would begin executing search warrants across 3 states. Within 90 days, they would uncover an organization responsible for moving over $3.8 billion through the real estate market, a sophisticated property flipping cartel that had corrupted assessors, appraisers, loan officers, and regulatory officials across an infrastructure spanning New York, New Jersey, and Connecticut. The conspiracy's architect, Richard Meridian, 58, former deputy commissioner of the New York City Department of Finance, a man who had spent 23 years in public service, a man whose biography hung in city buildings, a man whose daughter worked as a civil rights attorney, a man who, for nearly a decade, had orchestrated one of the largest real estate fraud networks in American history. The initial discovery. The discrepancy in that single file should have been nothing. Where property valuations fluctuate, assessment errors happen, but the junior analyst, her name would eventually be mentioned in federal court as part of the investigative chain, had run the numbers twice. She was trained to be precise. She was also trained to trust her instincts when something didn't match the patterns. The address in question was a 12-story commercial building constructed in 1989, office space on floors 2 through 9, retail on the ground floor, parking in the basement, built by a developer who had since retired to Florida, sold 7 times in the past 15 years, each sale documented, each assessed at increasing valuations with each transfer, except the increases didn't match market data. The building had sold for $32 million in 2016. 4 years later, after 2 intermediate sales through entities she couldn't immediately identify, it reassessed at $47 million. But comparable properties in the same district with identical square footage and similar condition assessed in the $38 to $41 million range. The building's assessed value had jumped 14% above market average for no documented reason. She pulled the chain of title. The intermediate purchaser, Meridian Properties Group, LLC, registered in Delaware. The entity had purchased the property for $34 million and sold it 18 months later for $39 million. Profit margin, clean and modest. Nothing that triggered fraud indicators. The sale itself had been properly documented. The transfer tax was paid. The deed was recorded. But the assessed value jumped only after Meridian's involvement. She requested the appraisal report supporting the post-transaction assessment. The appraisal was dated 3 weeks after the final sale closed. It had been conducted by a licensed New York appraiser named Harold Vincenzo, who had a 30-year track record in commercial real estate assessment. His report was thorough, detailed, footnoted, professional in every measurable way, except his assessed value was $7 million higher than market analysis suggested. The junior analyst ran a secondary query. How many other properties had Vincenzo appraised in the past 3 years? The system returned 134. She began cross-referencing those properties against market data. By noon on Tuesday, she had identified 17 properties where Vincenzo's appraisals exceeded comparable market valuations by margins ranging from 8 to 19%. The total variance across those 17 properties, $84 million in inflated assessed value. She escalated the finding to her supervisor at 1:15 p.m., Her supervisor escalated it 90 minutes later to the IRS Criminal Investigation Division. By Wednesday morning, federal agents had obtained preliminary warrants for Vincenzo's office files and bank records. What they found ignited the entire investigation. The methodology revealed Harold Vincenzo's bank records told a story written in deposits and wire transfers. Between January 2016 and February 2024, Vincenzo had received deposits totaling $2.4 million from entities he could not explain. The transfers came irregularly, sometimes $50,000, sometimes $180,000, but always within days of property appraisals he had conducted, always from shell companies registered in Delaware or Nevada, always routed through intermediate accounts before reaching his personal checking account. Agents executed a search warrant on Vincenzo's office on a Thursday morning at 6 a.m. They found his work computer, his handwritten files, his calendar, his transaction logs. They found spreadsheets documenting which properties to inflate and by what percentage. They found encrypted notes with references to clients and targets and desired valuations. They found a Rolodex entry, Richard Meridian, primary contact. By noon Thursday, agents were interviewing Vincenzo at his attorney's office. Vincenzo, Nostarst, who had been in private practice for 30 years and had never faced regulatory action, understood immediately what was happening. His attorney advised him to remain silent. Vincenzo chose differently. He chose to tell the agents everything. What emerged over the next 48 hours of debriefing was an organization that had operated with surgical precision. Richard Meridian, using his knowledge of city assessment procedures and regulatory architecture, had constructed a network for systematizing real estate fraud. The operation worked like this. A property would be identified, typically middle-tier commercial real estate with $25 to $60 million valuations. Meridian's associates would arrange a purchase through an intermediary entity. The property would close at market rate. Then, weeks after the transaction, Vincenzo would be contracted to provide an appraisal. The appraisal would inflate the property's value by targeted percentages, always enough to be credible but not so excessive as to trigger automated fraud alerts. The inflated assessment would stand in official city records. Property owners, some knowing, most unknowing, could then refinance at the inflated valuations. Banks, relying on official city assessments, would approve loans based on assets worth considerably less than the loan amount. Meridian's network would arrange the takeout of those loans. The proceeds would be split. The property owner received their cut, Meridian's organization took theirs, bank officers received their commissions, and appraisers like Vincenzo received their regular payments for consulting. The mechanism was simple. The scale was extraordinary. From 2016 forward, Meridian's network had moved properties through this system. Agents would later calculate that across 243 separate transactions, over $3.8 billion had been cycled through inflated property valuations and subsequent refinancing arrangements. The architecture of corruption. The investigation's scope expanded exponentially once authorities understood the conspiracy structure. Meridian had recruited deliberately. He had targeted individuals in positions of institutional trust who possessed specific vulnerabilities: a loan officer drowning in child support obligations, an assessor facing medical bankruptcy, a junior city official passed over repeatedly for promotion. For each person, Meridian had offered a specific problem solution. For the loan officer, the payments eased his financial crisis. For the assessor, the supplementary income came with plausible deniability. Consulting work, he would tell himself, for private firms needing validation assessments. Meridian had also insulated himself. He never handled money directly. He never conducted appraisals himself. He never directly negotiated with banks. He maintained a position as a private real estate consultant, maintaining his public dignity as a former city official. He wore Italian suits. He sat on charitable boards. His name appeared in society pages in connection with museum galas and university donations. Between 2016 and early 2024, he had moved approximately $147 million through his personal accounts and business entities. He had funded the purchase of a $9 million vacation property in the Hamptons. He had made contributions to his daughter's law school totaling $340,000. He had invested in commercial ventures entirely unrelated to his conspiracy, but funded by its proceeds. He had also, investigators would later discover, actively worked to suppress internal investigations within the Department of Finance. As deputy commissioner, Meridian had maintained access to department systems years after taking voluntary retirement. When a lower-level auditor had begun asking questions about assessment irregularities in 2021, Meridian had flagged the situation to allies still employed in the department. The auditor was quietly transferred and discouraged from pursuing her concerns. She had been silenced not through violence but through professional retaliation. The coordinated takedown. Federal prosecutors moved methodically through discovery and indictment. By late June 2024, the Southern District of New York had secured indictments against 14 individuals and 2 corporate entities. On July 8, 2024, at 6:15 a.m. across 3 states, federal agents executed arrest warrants in coordinated sweeps. Richard Meridian was arrested at his residence in Manhattan as he prepared for work. He was found in his study, sitting at his desk, apparently having already learned through his network that indictments were pending. He surrendered without resistance. He spoke to no one. His attorney, when contacted, offered a single statement. His client would enter a plea of not guilty. Simultaneously, agents arrested Harold Vincenzo at his home in Westchester County, Thomas Chen, a loan officer at Metropolitan Bank who had approved $340 million in fraudulent refinancing arrangements, Maria Santos, a property assessor employed by the city for 19 years, who had manually adjusted assessment records in coordination with Meridian's timeline, David Krawitz, a real estate attorney who had structured the shell company entities that obscured the transaction chains, Susan Lombard, a city official in the Department of Finance who had provided Meridian with advance notice of internal audits. 8 additional individuals, lower-level participants in the conspiracy, surrendered voluntarily to their attorneys' offices, understanding the evidence against them was comprehensive. The 2 corporate entities, entities, both registered in Delaware and never having conducted legitimate business beyond real estate holdings, had their assets seized and frozen pending proceedings. The institutional reckoning, the investigation revealed something worse than simple theft. It revealed institutional failure at multiple levels. The Department of Finance, when subjected to internal review, discovered that assessment procedures had remained fundamentally unchanged since 1987. No digital verification protocols existed, no cross-referencing systems comparing assessed values against market databases. No automated alerts when a single appraiser exceeded statistical variance norms. The department had been operating on a processing system vulnerable to the exact methodology Meridian had exploited. The Banking Commission discovered that no systematic verification procedure existed requiring banks to independently verify property assessments before issuing loans. Bank officers received official city assessments and, trusting their government origins, processed lending decisions without secondary validation. Metropolitan Bank had issued $340 million in loans exceeding actual property values by an average of $7.2 million per transaction. The State Attorney General's office opened an investigation into whether additional networks, operating under similar methodologies, had exploited the same architectural vulnerabilities. Preliminary inquiries suggested at least 2 other organized groups had been engaged in comparable fraud, though none with Meridian's sophistication or scale. The sentencing and aftermath. Richard Meridian accepted a plea agreement on March 11, 2025, entering guilty pleas to 15 counts including wire fraud, conspiracy, and public corruption. Sentencing was scheduled for June. In a federal courtroom in Lower Manhattan on June 14, 2025, Meridian stood before Judge Patricia Hernandez. The courtroom was full. Journalists filled the public gallery. City officials sat in attendance. Several victims of the conspiracy, property owners who had been unknowingly swept into the scheme, investors who had purchased inflated properties, bank customers whose accounts had been compromised through fraudulent loan transactions, sat in the rear section. Judge Hernandez delivered a 40-minute statement. She detailed the conspiracy's mechanics. She outlined the breach of public trust. She articulated the scope of financial harm. She noted that Meridian, a man whose professional biography represented meritocratic achievement, had corrupted the institutional mechanisms he had sworn to protect. She sentenced Richard Meridian to 18 years in federal prison. She also imposed restitution totaling $247 million, representing the documented proceeds of fraud, though prosecutors acknowledged that complete recovery would likely prove impossible given the complexity of asset dissipation. Harold Vincenzo received a sentence of 9 years. Thomas Chen received 7 years. Maria Santos received 6 years. David Krowitz received 8 years. Susan Lombard received 5 years. The institutional reform. In the conspiracy's aftermath, New York City implemented new property assessment protocols. Digital verification systems were installed requiring cross-referencing between assessor valuations and independent market databases. Automated alerts were programmed to flag when individual appraisers exceeded variance thresholds more than once annually. All appraisers were required to disclose all clients and sources of income above $50,000 annually. The State Banking Commission issued new guidelines requiring banks to independently verify property assessments for any loan exceeding $5 million, using separate approved appraisers who had no connection to the initial valuation. These reforms cost $47 million to implement. They would have prevented the Meridian conspiracy entirely. That junior analyst in the tax records division, the one whose attention to detail noticed a single discrepancy in a single file on a routine Monday morning, received a commendation from the IRS and the Department of Justice. She was promoted within her department. Her name would appear in the federal court record as a key figure in initiating the investigation. She told journalists afterward that she had simply been trained to look for things that didn't match. She had been doing her job. But that job, that ordinary observation of patterns and inconsistencies, had exposed corruption reaching into the highest levels of city government and criminal enterprise spanning $3.8 billion. One file, one discrepancy, one analyst paying attention. That was how systems failed, and that was how they were, finally, forced to repair themselves.